Welcome back. My name is Arya. I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we're going to talk about a company which I'm becoming increasingly interested in to possibly add to the portfolio, and that is in fact going to be Intuit. So in today's video, we're going to try to see whether or not Intuit is a company that is poised for outperformance on a going forward basis. Of course, as always, we're going to take a look at the qualitative and the quantitative aspects of the business, and at the end of it, we're going to rank order it based off valuation and try to compare it to other companies in my investable universe. So without further ado, let's get straight into it. Intuit owns a conglomerate of various different software businesses. So for starters, they have TurboTax and QuickBooks, these are the two portions of the business that they own, that they've built in-house. So QuickBooks initially started as like the accounting software for small businesses. So you have businesses that are maybe like 10, 15, or even less employees. Instead of trying to worry about being accountants and try to keep your books in check, you instead just get QuickBooks, and QuickBooks really helps seamlessly be able to take control of that and all that type of stuff. TurboTax is the other component of the business that they've built in-house, and TurboTax, many of you guys are probably even customers of TurboTax. I think they have like 60 million different users in America every single year that use TurboTax to file their taxes. That's pretty much it. It just has an incredible user interface, and it's become the default choice in America to file your taxes every single year. They got the free version, and they also have like premium versions of that, which we'll dive into later in the video. Additionally, they got Credit Karma and MailChimp. These are two components of the business that they've actually bought in recent years. Credit Karma, roughly $7 billion acquisition. MailChimp, about a $13 billion acquisition. Credit Karma, long story short, it just gives you visibility into your credit score. That's pretty much it. It's not really like a paid thing, but some people believe that Credit Karma actually drives extra. It's kind of the ecosystem mode, right? Like once you're on Credit Karma and TurboTax, it kind of helps out with adding sales to TurboTax. Intuit themselves, the reason they bought it is because they believe there's a lot of synergies and cross-selling ability that is unlocked by owning Credit Karma and being able to cross-sell onto TurboTax. MailChimp, last but not least, this is the bigger acquisition of the two, and this one is essentially a customer relationship management, and especially is more tilted towards marketing emails and all that type of stuff. The reason they bought this one is because they believe there's a lot of synergies that could occur between QuickBooks, which serves as accounting software for small businesses, and additionally MailChimp, which now you could cross-sell MailChimp onto QuickBooks and be able to sell email marketing tools and all that type of stuff to small businesses. So now that we have a gist of what the general segments of the business are, we're going to jump over to a Substack that I found. I'm going to link it in the description if you want to read the whole thing. I highly recommend. You could even just stop watching this video and just read this entire thing. Excellent Substack. But I'm going to read you an introduction on all the various components of the business. So for starters, they say Intuit is the leading financial management software provider for consumers and small to medium businesses. That's what SMB stands for, by the way. In the US, the company is best known for its TurboTax and QuickBooks products, right? So the in-house softwares that they actually built. They go on to say in fiscal year 2022, TurboTax software was used by 50 million filers, which is roughly 29% of total tax returns in the US, right? So they have roughly a 30% market share of that. That's how they file it. And then, of course, they got competitors like H&R Block and all that type of stuff. And then with TurboTax, they got a free deluxe and premium version. A little bit further down here, they talk about QuickBooks, and they say that customers use QuickBooks to manage their business finances like bookkeeping, payroll, invoicing, etc. And QuickBooks actually used to be mostly a desktop product where you just buy it one time and that's it. And then in 2013, they actually switched to a subscription model around the same time where Adobe, Microsoft, all these different just buy it one time software companies, like legacy software companies, they switched to a SaaS model. And this absolutely shows up on the revenue charts of the business. Scrolling a little bit further down here, this is really like the meat of things, the juicy stuff. As the leading financial management software provider for consumer and SMBs, Intuit benefits from their customer increasing switching costs with QuickBooks. This is absolutely true. I've actually used QuickBooks myself, and I know of people that use QuickBooks for their business. This is the exact same thing with Salesforce, right? Once you start integrating into Salesforce and once you start putting your customer data in there, how are you going to get that data off of there, right? With Enterprise, there is methods of getting it off there, but once you start putting your customer information in there and once you start doing all these different customer reach outs and all your invoices, the invoices that you issue to your customers once you do a job, how in the world are you possibly going to put that into a different software? It's not happening. It has to stay on QuickBooks. So once you start using it, like within a week, once you start issuing different invoices and stuff, it becomes so sticky that you're just going to continue paying it off. With that being said, the gross retention rates for QuickBooks compared to other businesses is in fact lower than the enterprise counterparts. So you got Workday, ServiceNow, Salesforce, of course, right? All these different software companies, they have much higher retention rates, roughly in the 90 to even 99% for ServiceNow, but QuickBooks is only in around 80%. Why is that? For QuickBooks, there's actually a lot of customer failure. So a lot of small businesses within the first 5 years, I'm sure you guys have heard heard like 90% of small businesses actually fail. So that lands you at like 20% attrition rate, right? 80% retention, 20% attrition rate. That means that over time, within like a 5, 7, maybe 10-year span, you're having a lot of businesses actually just shut down business. And that's why they stop using QuickBooks. So it's not necessarily a thing of like, oh, they're switching to a competitor or QuickBooks to something else. It's more of they're literally going out of business. That's why they're stopped using QuickBooks, right? So that kind of explains away the 80% retention rate. But even with that, compare it to other different companies in the same sphere, like H&R Block and all that type of stuff. They're roughly in like the 70% range, or even like Sage Software. It's estimated that it's like significantly lower, right? Additionally, something on top of that makes QuickBooks just a little bit stickier compared to its competitors. It has a lot of integrations with stuff like PayPal, Square, Bill.com, Shopify, all this other stuff, right? So with small businesses, oftentimes they're using all these different softwares and all these different payment networks and all that type of stuff, right? So there's a lot of integrations where you could just incorporate that into the QuickBooks workflow, right? And then the author of this Substack actually put a visual for us. So you could see here in year one, this is the idea, and this is a thesis with Intuit as a whole. With year one, they open a QuickBooks account, and their ARPC stands for average revenue per customer. So they're spending roughly $400 at Intuit on the first year. In the second year, they're like, oh, okay, maybe we need to get some payments going, right? So Nick starts using payments to make it easier to get paid. And then in year three, they also hire additional employees, and they start running the payroll on QuickBooks. QuickBooks could scale as time goes on. So if you only need just the core QuickBooks offering, you just start using that just for the accounting purposes, and then you start doing your payments on QuickBooks. And then as your business scales in year 3, 5, whatever, QuickBooks could also scale with you. So you start doing your payroll, you start doing your payments, you start doing HR, you start doing everything on QuickBooks. And obviously, you're going to stick with QuickBooks as opposed to opening up a new software because you already started out with it and it's incredibly sticky. Your data is already on there and it integrates very well, right? Similar thesis to Salesforce and all the other software companies we've covered on the channel. And then on top of that, to add to the ecosystem mode, once you start using QuickBooks, once you start using all the different softwares and MailChimp and all that type of stuff, and you're doing all your payroll, your accounting, all that type of stuff, odds are you're just going to use TurboTax to file your taxes. Why? Because they have all your data. QuickBooks has every single part of your data and what you invoice the customers for and everything you paid for and all that type of stuff. So it's incredibly easy just to put everything on TurboTax and pay the business level price of TurboTax, which is like a couple $100 probably a year. It just makes sense to do that as opposed to go to H&R Block and go through with an accountant and do all this other stuff, right? It just becomes a hassle to do all that. Or you could just very easily, very quickly move on to TurboTax, right? So again, kind of speaking to the ecosystem moat that Intuit has been able to build for themselves. And then on top of that, once you start using TurboTax for like a year or 2 years, they have all your data of filing it every single year. So when you go to file your taxes for the third year, they already have your data from previous years and they could auto-fill certain things and they could save you time on that front. And as we know, many people, they actually file their taxes within like a week or 2 weeks of tax season being due, right? Like they just file it at the start of April, right? So in a panic of let me get it done, you're not going to think about, oh, maybe I could save $100 here. Maybe if I go over here, TurboTax that has all your data from previous years and it's going to autofill and you don't have that much time and you have to go through this tedious process. You're just going to go with the software that you've used in previous years that can autofill all your information and you're used to the user interface and you know you're not going to make a mistake. So now that we covered some of the qualitative aspects of Intuit and why I think it actually has a very, very wide moat, I want to jump over to some of the financials of the business. So for starters, I'm going to go over the margins because of course this is a software business and it has incredible margins. 80% gross margins, which means that it costs them roughly $2 to be able to generate $10 of revenue. That is absolutely incredible. And of course, I'm talking about the actual cost of goods sold. So the cost to actually sell and distribute the software. Moving a little bit further down, the operating and cash flow margins are roughly 24 and 32% respectively. Operating margins, this is including things such as the employees in the office buildings and your sales and marketing and all that type of stuff, the capital expenditures into building those office buildings and all that type of stuff, right? So again, very strong margins all around. Now jumping over to the growth, of course, margins are great, but how much are you growing by? The expected earnings per share growth in the next 3 to 5 years is expected to be roughly in the 17% range. And looking to historical, we know that this is backed up by very strong revenue CAGR, but I should mention that they've actually acquired the two businesses, Credit Karma and MailChimp. So this is kind of artificially boosting the trailing revenue figures. But again, even on a going forward basis, it looks like the analysts are actually expecting roughly 12% revenue CAGR. So we're saying a little bit margin expansion and a little bit buybacks and all that type of stuff. That adds it to like a mid to high teens bottom line growth on a going forward basis. And of course, free cash flow, which is something that I pay the utmost attention to, we could see that it's also falling in line. So again, roughly like a 15% CAGR is what's expected on the free cash flow number with like like a 2%-ish buyback and like the dividend, all that type of stuff, your total return, you're looking at like 17%. Something that you should take into account with Intuit though, is that they actually issue a lot of stock-based compensation, roughly $2 billion on $5 billion of free cash flow. So that lands you at like 35% of free cash flow being stock-based comp. I think this is going to slow down in the future. Just as an industry-wide thing, we're seeing massive slowdowns in stock-based compensation. And additionally, the CEO of the business has actually signaled that, yeah, they have all the different hires that they want and they have all the employees. They don't need to go out and aggressively hire like they used to in 2020, 2021, all that type of stuff, right? So on a going forward basis, we should see this stock-based comp number grow slower than the free cash flows, and hopefully that creates an extra margin in between there. With that in mind, you guys are probably thinking, Arya, this is a great business, right? Like I'm not discounting that. It looks like they got the ecosystem going. They got QuickBooks. It's incredibly sticky. TurboTax. They can autofill your information. Ingrains very well with QuickBooks. They got the other apps that are kind of hazy, but whatever. What's the risk factors? And to answer that question, I'm going to jump over to Morningstar, which is a research firm. They do excellent research. I highly recommend looking into them. But they mention a couple risk factors, which I actually like. Usually I don't agree with the risk factors of most of these wide moat businesses. They're just writing something for the sake of like having it in there. I actually tend to agree with these. So the first thing, Intuit, roughly in the 2006 or so, 2002. So in 2002, they talked to the IRS and they said, we need the tax software that you have Intuit, the TurboTax software. We need that to have a free tier where people with the income bracket of roughly 66,000 and under, they have a free option to be able to file their taxes. This is unfair that you're like charging them to pay. Intuit's like, okay, no problem, cool. All the people under 66,000, which obviously this increases over time, but under this threshold, we're going to offer them completely free. And the way they got around that, this is just absolutely brilliant. The way they got around that, they offered a live agent sort of thing, right? So when you're in the middle of filing your taxes and you're filling in all the information and you're like, oh, should I include this interest income in my high yield savings account? I have no idea. Google's not being too helpful. You have the option, for, I don't know, 20, 30, whatever dollars, you could hop on a call with a verified agent that they actually know the tax code and all that type of stuff. And you could ask them a question very quickly, very efficiently. And you could be like, oh, what do you think of this? And you get their opinion on it. And based off that, you're able to make a decision whether or not to include that in your taxes. Absolutely brilliant strategy, right? So that's the way they got around that. But over time, the IRS has kind of given them some flack of like, you have this, but you're kind of putting some things behind a paywall. And if you want to access certain data or if you want to access certain features, why did you make it a paid thing? So they've given them trouble historically for that. So far, it hasn't materialized to anything big, but the IRS and the government themselves actually came up with their own software to be able to file your taxes for free. And so people are very scared of whether or not that could, in the long term, be material. Many people, especially in the lower income brackets, $200 is very material to their life. So it completely makes sense for them to, even if it's going to take a couple extra hours of their time and they're filing it themselves, completely makes sense to use the IRS's website as opposed to use Intuit and have to pay like $100, $150, whatever the case is, right? So that's number one. I would say it's a very material risk that could definitely hinder TurboTax's performance in the long term. But additionally, a risk to QuickBooks, which is also a very significant portion of the revenue, the risk to QuickBooks is actually small to medium businesses essentially shutting down business, right? So they have roughly a 20% attrition rate, meaning that 20% of customers every single year stop using QuickBooks. And that's not because they're switching away to other softwares. I'm sure that's some of it, very small amount. But the bigger problem is that if you're like a lawn care business, after a year or two, maybe it's not looking so good and maybe your business isn't going the way you expected it to, you're just going to shut down business. So naturally, QuickBooks actually has a lot of exposure to all these small businesses that continues to go bankrupt every single year. And I think if the economy were to get bad or whatever, that is something that could very easily blow up. This is not like an enterprise customer. This is not like Salesforce with their super enterprise customers and they have like mountains and mountains of cash and they're just absolutely fantastic businesses. There is risks incorporated with these companies going bankrupt. One last risk, which I kind of underwrite this just because of the mind share that QuickBooks has with literally everybody. Like when you go to get a accounting software for a small business, you're going to get QuickBooks. And especially if you consult with your accountant and you're like, oh, what is like your preferred software? Like, what should we do? The mind share that QuickBooks has built in the past 40 years is absolutely incredible. So I kind of underwrite this risk, but it is, at the end of the day, it could possibly turn out, right? So Stripe and Shopify, Stripe, of course, being the payment processor company, Shopify, which is used to make e-commerce websites that isn't Amazon. If they actually try to go into this category, that could pose as a risk, right? So if Shopify's sitting there like, hey, we already have all your payment information, all that type of stuff. Would you want to just use our software as opposed to like QuickBooks or something? We'll give you a discount, right? Like you're already a pretty big customer for us and all that type of stuff. They could kind of horizontally integrate all these different tools for their Shopify customers. Now, last but not least, jumping over to my free cash flow to growth calculator, we could take a look and try to compare Intuit to every single other business in my investable universe. Essentially what we're doing here is we're taking the current valuation of the company and we're dividing that by how fast we expect the company to grow by. So in the case of Intuit here, if we take a look, it's roughly at 40 times price to free cash flow, and we expect this company to grow at roughly the high teens free cash flow CAGR on a going forward basis. And the way I arrived at this number is I took previous free cash flow growth rates and I'm just adding roughly about 2% because I assume that that's like the dividend yield and especially the buybacks that the business is able to do because it's a very capital light business. I'm saying it's able to buy back and it's able to bring the CAGR up to roughly a 17%. And as we take a look, it's roughly in the 2.27 times free cash flow to growth multiple. And so with that in mind, I don't think Intuit is a company that interests me that much as it stands currently. I think qualitatively and especially fundamentally, this company backs up and it's a long-term winner. But I think it's just trading at a slight premium. If we were to maybe, drop this down to like a $500 share, you could see that it lights up green. So I think roughly in the $500 range, it starts to get interesting for me. But the problem I'm facing currently with the business is that when I have Salesforce trading at a significantly cheaper price to free cash flow multiple, and I would argue that Salesforce probably has as good as a moat, maybe even a wider moat, and they're giving the same amount of growth in the next like 5 years. Why would I bother buying any Intuit stock? And sure, it's not like a one-to-one comparison, but it is a software company that is kind of adjacent to Intuit. When I have Salesforce, and that is a screaming deal in my opinion, I don't think Intuit stands as that much of a deal in comparison. And at last, if you like the fact that I don't waste your time, I'd like to ask you to do something that costs you nothing but would help me out greatly. If you could hit the subscribe button, I'm going to continue to post high quality videos just like this one, and you could always go back on that decision if you end up not liking the videos, but I highly doubt that. Thank you for watching. Have a great day.